Businesses, families, and individuals like to keep track of the assets they own, the liabilities they owe, and the difference between the two, which we call equity or net worth. If we own a $100,000 house, we would call it one of our assets. If we don't owe a mortgage on the house, we would say that our equity in the house is also $100,000. If we owed $20,000 on a mortgage, we'd still claim the house as a $100,000 asset, but our equity would be $80,000. We can think of this equation as a balance bar on a fulcrum with our assets on the left fulcrum and our liabilities and equity on the right. The assets on the left are always equal to the sum of the liabilities and equity on the right. Let's say we saved up $10,000 over the years and we want to express our situation on the balance sheet. Since we don't owe anyone any money, we show our assets to be $10,000 in cash with a corresponding equity of $10,000. In the trial balance below, note that we express positive numbers on the left side of the fulcrum as debits and positive numbers on the right side of the fulcrum as credits. Now let's say that we decide to purchase a car with the $10,000. The car is an asset, so the balance sheet doesn't change very much, except that the asset is now expressed as a car instead of cash. We own the car entirely with no debt, so our equity remains at $10,000. Suppose we decide that the $10,000 car is not quite good enough for us, but the $12,000 model is just right. We procure a loan for $2,000 to go along with our $10,000. We now have a $12,000 car as an asset. Our equity is still $10,000, but we add the $2,000 loan as a liability. Looking at the trial balance, we see that each side totals $12,000, so we've maintained our balance. Businesses don't use little pictures of fulcrums, balance bars, and cartoon cars to express their assets, liabilities, and equity. If they did, however, their owners, stockholders, and board members would probably understand their equity positions much better. Typically, these items are expressed on a printed balance sheet with the assets and their values listed first. The asset section ends with a line showing the total value of all assets. The next section shows the liabilities with the total, followed by the total equity. The final line on the balance sheet shows the total of the liabilities and equity added together, so readers can see the asset total equals the liabilities plus equity. If a business or person sold off all their assets and paid off all their liabilities, the equity is what would be left over. Examples of accounts you will find in the asset section are cash, accounts receivable, which is the money owed to the company, typically by customers, inventory, the value of items held for sale to customers, equipment, the value of equipment used to produce the company's products and services. Liabilities include accounts payable, which is money that we owe to others, typically vendors, from which we regularly make purchases. Sales tax payable, which are the sales taxes we have collected from our customers but not turned over to the state. Withholding tax payable, which is the taxes we've withheld from employed paychecks but not turned over to the IRS. Credit cards payable, which is money that we owe to credit card companies for purchases, and notes payable, which is money we owe on loans from lending or other financial institutions. Equity accounts are usually called equity or capital. In the case of a corporation, they sometimes show retained earnings, which is the profit left over that was not paid out in dividends to the stockholders. We sometimes use a small diagram called a T account to record additions and subtractions from our accounts. If the account is an asset, additions are recorded on the left side of center, subtractions on the right side. Equity and liability accounts are just the opposite. Suppose Johnny opens a checking account with $500 of his own money. The first thing we do is record the addition of $500 to the cash account on the debit side. The next thing we do is record an addition of $500 to the equity account on the credit side. When Johnny buys a lawnmower, we record a subtraction from the cash account on the credit side of the purchase price of $450. The money was used to purchase an asset, a piece of equipment, so we record an addition of $450 to the equipment account. We can then work up a trial balance to make sure that we maintain the totals in balance. There's $50 left in the cash account after paying for the lawnmower, so we post $50 as a debit to the trial balance for cash. Next, we post $450 as an asset to the equipment line in the trial balance, followed by posting the $500 credit to the equity line. Both sides total $500. The balance sheet is considered to be a snapshot of assets, liabilities, and equity at any given point in time. Businesses conduct sales activity to generate revenue, and in doing so incur expenses required to generate the revenue. Every time there is a sale, it really increases the equity, but then every time there is an expense, it reduces equity. Without some kind of special reporting, all these increases and decreases in equity resulting from sales and expenses would be recorded in detail in the equity account. This example shows a $200 sale recorded as an increase in equity with two expenses of $75 and $50 shown as deductions. Note that the difference of the sales minus expenses, or the profit from the sale, of $75 represents the net increase in equity. Instead of recording every sale and every expense to the equity account, businesses use a profit and loss statement to summarize the results of sales and expenses for a given period of time. The net result, either profit or loss from the sales and expenses for the period, is the only item that appears in the equity account. Here you see the $75 profit from the bottom of the profit and loss statement added to the equity account. The profit and loss statement is also referred to as the P&L or the income statement. There are also debit and credit rules for increases and decreases to the expense and revenue accounts. Here we've added expenses to the left side of the balance. Those increases are debits and decreases are credits. On the right-hand side we show the revenue accounts, increased by credits and decreased by debits. In the previous example, the cash account was increased when there was a sale and decreased when there was an expense. Customers don't always pay cash when they make purchases. Sometimes they pay later. We use the asset called accounts receivable to keep track of the money that the customer has agreed to pay later in exchange for the purchase of goods or services from us. Here's a transaction where the customer made a $25 purchase and put it on account rather than paying cash. The transaction was a sale, so the sales account is increased by a credit of $25. The corresponding debit was made to accounts receivable instead of cash. Later, when the customer pays the bill, we decrease the accounts receivable balance with a credit of $25 while increasing the cash account with a debit of $25. After an initial introduction, nobody really totally comprehends the debit and credit process as related to standard bookkeeping and accounting practices. However, as you work with bookkeeping and accounting systems, a basic understanding of the concepts will eventually start falling into place.